One of the most uncomfortable truths in investing is that the greatest gains often come from doing nothing. No new trades, no strategy tweaks, no emotional reactions, no desperate attempts to outsmart the market. Just time, patience, and the discipline to leave your money alone. This goes against everything we've been conditioned to believe. We grow up learning that success is tied to effort. More hustle, more grinding, more movement. So when someone hears that stillness could create wealth, the mind rejects it. It feels wrong. It feels lazy. It feels passive. But the market is not life, and it does not reward constant motion. In fact, the market punishes it. The investors who become wealthy aren't the ones who make the most moves. They're the ones who make the fewest and then allow time to magnify those decisions. Doing nothing does not mean being careless or uninformed. It means being selective. It means acting only when your understanding is clear, your conviction is strong, and your emotions are calm. It means resisting panic when everyone else is panicking, resisting euphoria when everyone else is celebrating. It means treating investing as a marathon, not a sprint. The wealthiest investors in the world, Warren Buffett, Peter Lynch, Charlie Munger, built fortunes by sitting still while the rest of the world chased noise. Buffett once said, "The stock market is designed to transfer money from the active to the patient," and most people don't realize how literally true that is. The world overestimates intelligence and underestimates temperament. Anyone can learn how the market works, charts, earnings, fundamentals, but almost no one can master their own impulses. And that is why doing nothing is powerful, because it requires emotional strength. It is not easy to wait when screens flash red and headlines scream doom. It is not easy to stay calm when greed whispers that you could have made more if you just took one more trade. But the market is a test of character disguised as numbers. The ones who win are the ones who feel everything, fear, excitement, temptation, and still don't move. Wealth is not built during moments of action. It is built in the spaces between action, where time compounds in silence. The modern investor confuses activity with progress. They think that clicking buttons, reacting to news, and constantly adjusting their portfolio means they're being responsible and engaged. But in reality, most of that motion is just noise in motion, a psychological compulsion to do something to feel in control. This is not strategy. It's insecurity wearing the mask of productivity. Millionaires don't move simply because the market moves. They act only when there is reason. Their decisions come slowly, carefully, deliberately, and then they let time do what time does. Think about a tree. You do not dig it up every week to check its roots. You water it, you position it in sunlight, you leave it alone, and it grows. The market works the same way. The investor who interferes constantly never gives their assets time to take root. The average investor buys, gets nervous, sells, buys again, and repeats the cycle until they've spent years working hard and going nowhere. Meanwhile, the quiet investor, the one who set a plan and stepped back, watches that same time turn stillness into strength. Effective action is precise, rare, intentional. It is the opposite of frantic movement. The real work of wealth building happens before the investment, in the research, in the clarity of understanding, in the assessment of risk. After that, the work is patience. But because patience is invisible, most people abandon it. They want to feel like they're doing something. They want the dopamine of action. That dopamine is the enemy. The market rewards those who can emotionally withstand the absence of stimulation. This is why patience is not passive. It is active discipline, and discipline is always valuable. The market triggers the same chemical pathways in the brain that gambling does. When prices move quickly, the brain floods with adrenaline and dopamine, the same chemicals associated with excitement, craving, and risk. This creates a psychological addiction to action. The investor begins to feel like not trading is missing out on opportunity. The mind becomes restless, silence becomes uncomfortable, boredom feels like failure. And so they trade, not because the conditions are right, not because the data supports it, but because the brain is begging for stimulation. This is how portfolios are destroyed, not by lack of intelligence, but by the inability to tolerate stillness. Most investors aren't chasing wealth, they're chasing sensation. They want the thrill of being in the game. But the wealthy investor understands something deeper. The market is not a game. It is a long-term psychological negotiation with your future self. Every impulsive decision steals from that future. Every unnecessary trade resets compounding. Every moment of panic or FOMO is a moment where emotion overrules logic. To break the addiction to motion, the investor must learn how to sit with discomfort, not avoid it, not numb it, sit with it, to feel anxiety without reacting, to feel excitement without chasing, to feel fear without fleeing. That is emotional mastery. And emotional mastery is wealth, because once you learn to stop moving when your emotions tell you to move, you have already surpassed 90% of investors. The irony is extraordinary. The market is won not by those who act the most, but by those who can wait the longest. The modern investor lives in a world drowning in noise. Headlines flash panic. Social media amplifies fear. Influencers make predictions to gain attention, not accuracy. Every day, thousands of voices scream about what the market is about to do, should do, might do. This constant stream of noise creates a false sense of urgency. It tricks people into thinking they must act now, or they'll be left behind. And this is exactly where most investors lose. They drown in information rather than clarity. They confuse activity with intelligence. They mistake noise for signal. Signal is rare, quiet, patient. Noise is everywhere, loud, desperate. Millionaire investors have learned how to separate the two. They don't react to headlines. They look at data. They don't chase hype. They examine fundamentals. They don't predict. They prepare. And most importantly, they ignore almost everything. They don't need to know what every analyst thinks. They don't need to watch every hour of market coverage. They don't need to consume every financial podcast. In fact, they deliberately reduce information intake. They know the human brain cannot handle overload. That excess input leads to emotional reaction, not strategic reasoning. Noise feeds impulsive behavior. Signal guides patient action. The investor who learns to filter, to tune out distraction, and tune into what actually matters, gains an advantage more powerful than any technical strategy: clarity. Noise will always exist. The market is fueled by emotion, but clarity belongs only to those who refuse to let noise inside. The real edge is not knowledge, it's selective attention. The richest investors aren't the ones who know the most, but the ones who ignore the most. The market is a machine designed to test temperament. When volatility rises, prices swing wildly, and fear grips the crowd. This is the moment where most investors reveal their weaknesses. They rush to sell when panic rises, or rush to buy when greed floods the system. But the wealthy do something radically different. They wait. They step back, observe, breathe. They understand that volatility is not something to fight. It is something to endure. Stillness is not inactivity. It is controlled non-reaction. It is the ability to experience chaos without becoming chaotic. It is the discipline to stay the course while others abandon ship. Most people believe the market rewards intelligence, but it actually rewards temperament. A calm mind outperforms a brilliant one in a storm. This is why some of the smartest analysts in the world are terrible investors. They can model markets, but cannot manage themselves. Wealthy investors have learned that doing nothing during chaos is often the most profitable move available, because panic is temporary, but losses from panic can be permanent. If you can hold your position through storms, you get to own assets others gave up out of fear. If you can buy when others are frozen, you enter at deep discounts. If you can simply not sell, you allow compounding to continue while others press reset on their growth. Stillness in the market is not passive, it is aggressive patience. It is the kind of patience that takes courage, not comfort, and that is why few have it, and why those who do become wealthy. Compounding is the single most powerful force in finance, and the least respected. Everyone understands it intellectually, but almost no one applies it emotionally. Compounding only works when uninterrupted. Every time you react emotionally, every time you sell too early, every time you panic out of a position, every time you chase a newer, faster, more exciting opportunity, you break compounding. And breaking compounding is like uprooting a tree before it matures. You reset growth, often without realizing it. Compounding requires time, and time requires patience. Wealthy investors understand that money grows slowly, then suddenly, the early years feel invisible. Returns are small. Growth feels stagnant. This is where most people quit. They assume it's not working. They assume they need to do more, so they tinker, they interfere, they move money around trying to force acceleration. But compounding isn't something you force, it's something you allow. Once you plant the seed, the only job is protection and time. The irony is that compounding accelerates after most people would have already given up. The majority quit in the slow slope before the exponential curve begins. The wealthy endure that slope. They know that the breakthrough doesn't happen in year 1 or year 2, but in year 5, year 10, year 20. Compounding is slow because it is building momentum, but once momentum takes over, wealth scales faster than effort. The investor's job is not to accelerate compounding, it is to stay out of its way. Everyone wants to buy at the bottom and sell at the top, but no one, not analysts, not banks, not hedge funds, not AI, consistently can. The idea that you can time the market perfectly is a fantasy sold to impatient minds. Wealthy investors don't try to catch peaks or call bottoms. They simply stay invested. They ride the full cycle. They hold through downturns and expansions alike. They understand that markets rise more than they fall, historically, repeatedly, mathematically. Meanwhile, the average investor jumps in and out, always reacting to fear or excitement. They buy high when the market is euphoric and sell low when panic hits. They try to outsmart uncertainty and end up losing to it. The investor who simply stays invested, even through recessions, ends up wealthier than the one who tries to be clever. Time is the ultimate multiplier, and staying in the market is how you let time work for you instead of against you. The wealthy don't need perfect timing. They need consistent positioning. They let the market's natural upward drift compound their capital. And because they don't constantly move in and out, they avoid taxes, fees, slippage, and emotional errors. The strategy is simple. Stay in, add consistently, wait, breathe. Let decades do what days cannot. Emotional trading is the most expensive habit in investing, more expensive than fees, taxes, and market downturns combined. When you trade from fear, you lock in loss. When you trade from greed, you expose yourself to unnecessary risk. When you trade from impatience, you sell your future to satisfy the present. Emotional decisions don't just cost money, they cost time, confidence, and compounding potential. Markets are mirrors for your emotional state. If you are are anxious, the market becomes threatening. If you are impatient, the market becomes slow. If you crave excitement, the market becomes a casino. The wealthy don't let emotions drive action. They let strategy guide behavior. They feel fear and stay. They feel greed and stay. They feel uncertainty and stay. Emotion does not disappear. Emotional reactivity does. Every emotional trade reinforces emotional decision-making. The brain learns. When I feel, I act. But the wealthy condition the opposite. When I feel, I observe. This single shift is enough to build millions over a lifetime. Doing nothing sounds easy, but in investing, it's the hardest skill to master, because doing nothing means confronting your own thoughts. It means facing fear without acting. It means resisting the urge to respond to every fluctuation. It means believing in your plan more than your impulses. Most people avoid stillness not because they lack strategy, but because they lack emotional tolerance. They cannot endure boredom. They cannot endure uncertainty. They cannot endure silence. So they move, they tweak, they tinker. They sabotage compounding because activity soothes anxiety. Millionaires are made not in moments of action, but in the moments they refuse to be controlled by discomfort. Doing nothing is not passive. It is active self-control, and control is profit. Patience is not something you're born with. It's something you train. Anyone can become patient with repetition, reflection, routine, and self-awareness. Patience grows through practice the same way muscles grow through resistance. The resistance is the growth. Every time you resist panic selling, patience grows. Every time you resist chasing hype, patience grows. Every time you ignore noise, patience grows. Patience is the strongest competitive edge in investing, and the rarest, because the market is not won by the fastest thinker. It is won by the slowest reactor. There are two archetypes in the financial world: the trader who runs toward excitement and the investor who runs toward time. One ends exhausted, the other ends wealthy. The trader is addicted to adrenaline. They need movement to feel alive. They chase volatility, chase news, chase trends, chase the thrill of being in the action. They believe wealth is something you capture if you move fast enough, if you react sharply enough, if you beat others to it. But the irony is painful. The market is faster than everyone. The market is unpredictable longer than traders can stay enthusiastic. The market is a game where the house is time, and time always wins. The investor who becomes wealthy does not try to outrun the market. They walk alongside it. They understand that the market is volatile in the short term, but overwhelmingly upward in the long term. They are content to appear slow while others appear intelligent. The trader looks impressive today. The investor looks inevitable tomorrow. The trader wins attention. The investor wins wealth. The trader is praised for action. The investor is forgotten until the portfolios mature. The wealthy understand that impatience burns capital and emotional stamina. A person can only trade from adrenaline for so long before fatigue sets in and mistakes multiply. Burnout isn't financial, it's psychological. It is the exhaustion of always needing to do. The wealthy do not chase, they position. They do not react, they anticipate. They do not bet, they accumulate. The trader's identity is built on motion. The investor's identity is built on meaning. One is fueled by fear, the fear of missing out, the fear of irrelevance. The other is fueled by freedom, the freedom to let time work for them. And the truth is simple but uncomfortable. Wealth is earned by the person who is most willing to seem like they are doing nothing. To the outside world, the wealthy investor looks passive, but internally they are practicing mastery. Slow wealth is quiet wealth. Quiet wealth is lasting wealth. Human beings are biologically wired to avoid waiting. Our ancestors did not survive by being patient. Survival required urgency, alertness, and quick reaction to threats. The part of the brain that controls fear and impulse, the amygdala, still operates as if danger is everywhere. When the market dips, the brain interprets it like a predator approaching. Panic is not stupidity. It is biology. The rational brain knows that downturns recover, but the emotional brain screams, act now or lose everything. This is why patience in investing is not natural, it is trained. The wealthy investor learns how to override ancient survival programming. They learn how to breathe through fear responses. They learn how to treat anxiety as a signal to pause, not act. They learn to examine emotion instead of obeying it. They learn to let the logical brain, the prefrontal cortex, take control. This takes repetition, awareness, and emotional conditioning. The brain hates waiting because waiting creates uncertainty, and the brain craves control. That is why people check stock apps 30 times a day. It is not to gain information. It is to temporarily quiet anxiety. But every time they look, they reinforce the belief that outcomes need surveillance. The wealthy break this cycle. They structure life so that the market is not a constant companion. They check quarterly, not hourly. They evaluate long-term performance, not minute-by-minute fluctuation. They do not let the nervous system attach to the ticker. They know the real battle is not with the market, it is with biology, and they learn to win. Boredom is the psychological cost of compounding. It is the feeling of nothing happening while everything important is happening invisibly. Compounding does not reward emotion. There are no fireworks, no adrenaline spikes, no continuous feedback loops, just slow, silent growth. Most people cannot tolerate that. They crave stimulation. They need to feel progress, even if it means sabotaging progress. This is why the majority will never experience compounding at its full potential, because they abandon the process during the quiet years. The wealthy understand that boredom is not a sign something is wrong. Boredom is a sign something is working. The moment investing feels exciting is the moment risk has replaced reason. Excitement is a signal of emotional involvement, and emotional involvement leads to self-sabotage. The wealthy deliberately design lives rich enough outside investing that they don't need the market to entertain them. They have meaning, hobbies, health, family, curiosity, purpose. Their lives are interesting enough that investing can remain boring, and that is the edge. If you need the market to entertain you, you will never let it enrich you. The most destructive instinct an investor must overcome is the desire to do something during discomfort. When the market drops, the urge to fix it becomes overwhelming. When prices rise, the urge to lock in profit feels logical. But both urges come from fear. Fear of loss or fear of regret. The wealthy train themselves to recognize that these urges are emotional reflexes, not strategic insights. They understand that markets move in cycles, and cycles require full participation, not constant interruption. The need to interfere comes from insecurity. What if I'm wrong? What if this disappears? What if I miss out? But the wealthy operate from a different question. What does history show? What does strategy support? What does patience earn? They learn to see the urge without acting on it. They learn to wait until emotion and logic disconnect and move only when logic remains. Stillness becomes strength. People trade not to gain profit, but to gain a sense of control. Pressing the buy or sell button provides temporary relief, a momentary illusion that they have taken charge. But the market is larger than any individual. Control in markets is largely an illusion, and the wealthy accept that. They do not attempt to control price movement. They control exposure. They do not try to control the economy. They control allocation. They do not try to control volatility. They control reaction. Once you release the illusion of control, patience becomes easier because you stop trying to fight reality. And the moment you stop fighting reality, you start compounding wealth. Most people miss opportunities not because opportunities are rare, but because their minds are too loud to recognize them. Constant trading, constant reacting, constant movement leaves no room for insight. Stillness creates space. Space allows observation. Observation allows understanding. Understanding allows timing. The wealthy see opportunities others cannot not, because they are smarter, but because they are calmer. Clarity is born in quiet, not chaos. The dream of true wealth is effortless accumulation. Your money grows even when you're asleep, on vacation, or spending time with loved ones. This is only possible when your portfolio is positioned and protected and left alone. When you do nothing, your investments continue working. When you interfere, you interrupt their work. Most investors sabotage themselves because they cannot allow wealth to grow without their involvement. The wealthy trust time. Their portfolio works because they don't. Most people never become wealthy not because they fail to pick winning investments, but because they fail to hold them. They get a small gain and immediately sell, terrified of losing the little progress they've made. They trade profit for relief, but relief is temporary and the cost is extraordinary. They interrupt compounding before it accelerates. Millionaire investors do the opposite. They let their winners run. When they find something strong, resilient, and growing, they stay. They don't rush to cash out just because there's a profit. They understand that the largest portion of returns happens long after the investment feels successful. Look at the greatest wealth stories in financial history. They are always stories of holding. Buffett holding Coca-Cola, Apple, and American Express. Venture capitalists holding early tech stakes for a decade. Real estate investors holding prime land that multiplied in value, while others flipped properties for small, fast gains. The wealthy know that real gains require emotional maturity. The beginner takes the first exit because they don't trust the future. The wealthy expect growth to take time. They understand that every dollar you pull out of a winner now is $100 you kill later. Letting winners run demands stillness in victory, which is just as difficult as stillness in fear. You must resist the ego that wants to lock in success so you can feel smart in the moment. You must resist the temptation to take profit for validation. Wealthy investors measure results in decades, not days. They are not collecting wins. They are building empires, and empires are not built by constant liquidation. They are built by letting compounding do what compounding does, grow slowly, then suddenly. Every time you pull money out of a long-term investment prematurely, you don't just lose the growth on that amount. You lose the growth that growth would have created. This is the silent tragedy of impatience. The cost isn't the gain you take. It's the exponential gain you erase. Most people never realize how significant this damage is because the loss is invisible in the short term. It feels small, it feels harmless, but compounding isn't linear, it's exponential. The difference between holding 5 years and 20 years is not 4 times. It's often 20 times, 40 times, sometimes 100 times. Interrupting compounding is like pulling up a seedling to check on its roots. You don't just slow growth, you reverse it. The wealthy understand this deeply. That's why they don't panic when markets drop. They don't obsess over short-term valuation bumps. They don't chase faster returns somewhere else. Once they've planted an asset that grows reliably, they treat it with respect. They protect it. They defend it. They don't allow temporary emotions to destroy permanent potential. The average investor works for their money. The wealthy let their money work for them, uninterrupted. The question that divides the two is simple. Do you trust time more than your impulses? If not, You will always be resetting your growth curve back to zero. The long game is uncomfortable because it requires endurance without applause. You do not get immediate reward. You do not get acknowledgement. You may even look foolish to others who are chasing fast results. People will ask why you aren't doing more. They will question your patience. They will insist you are missing out. But wealth is not built in comparison. It is built in conviction. Millionaire investors see the world differently. They don't ask, how fast can I grow? They ask, how long can I stay aligned? They know that consistency beats intensity, that a quiet decade beats a noisy month, that maturity isn't measured in how quickly you can gain, but in how gracefully you can wait. The long game is psychological warfare, not against the market, but against the ego. It forces you to detach your identity from short-term outcomes. It forces you to choose direction over dopamine. When you think in decades, noise loses power. Volatility becomes background static. Panic becomes irrelevant. The long game turns time from an enemy into an ally. And once time is on your side, wealth is inevitable. Warren Buffett and Charlie Munger did not become icons because they found a secret strategy. They became icons because they mastered patience at a level most humans will never reach. Buffett openly admits that the majority of his wealth appeared after age 60, not because he got smarter at 60, but because he continued compounding past the point where most people stop. Munger says it clearly. The big money is not in the buying or the selling, it's in the waiting. This is the lesson almost everyone hears, yet almost no one lives. People study Buffett's stock picks, but they ignore his temperament. People quote Munger's wisdom, but they ignore his restraint. They want the results without the discomfort that produces them. But the wealthy didn't become wealthy because they acted brilliantly. They became wealthy because they did nothing brilliantly. Stillness was their superpower. Time was their strategy. Patience was their identity. Most people will not become wealthy not because they lack intelligence, opportunity, or resources, but because they lack patience. They cannot bear the feeling of waiting. They want confirmation now. They want validation now. They want certainty now. But wealth does not pay in the present. It pays the future self. The average person trades long-term gain for short-term emotional comfort. The wealthy trade short-term emotional discomfort for long-term gain. That is the entire difference. Fast money is flashy, exciting, and unstable. Slow money is boring, peaceful, and permanent. Fast money promises identity. Slow money builds freedom. Fast money attracts ego. Slow money attracts stability. Fast money disappears as quickly as it arrives. Slow money compounds quietly until it becomes unimaginable. The question every investor must answer is simple. Do you want to look rich now or be rich later? Investing has seasons: accumulation, stagnation, decline, acceleration, harvest. The wealthy learn to accept each without panic. They understand that not every season is supposed to feel profitable. Some seasons exist only to test whether you deserve the profitable ones. Stillness is not a pause in progress. It is progress disguised as waiting. The ultra-wealthy do not measure time the way most people do. To the average mind, time is an obstacle, something that stands between them and what they want. To the wealthy, time is the asset, the working partner, the silent engine, the invisible worker that grows wealth in the background. The average investor asks, how long will this take? The wealthy ask, how far can this grow? One sees time as a cost. The other sees time as leverage. Time multiplies decisions that are aligned and punishes decisions rooted in impulse. It rewards patience, consistency, and emotional discipline, and taxes frantic movement. The wealthy think in decades, not days. They imagine future selves, not future moments. They don't ask whether something will pay off this year. They ask whether it will still matter 20 years from now. And because they calibrate decisions through long arcs, They naturally avoid noise, avoid panic, avoid the emotional chaos that destroys portfolios. This is why truly wealthy individuals rarely appear rushed. Their pace is deliberate, their breathing is slow, their decisions unfold like chess, not roulette. They are not obsessed with maximizing every moment. They are obsessed with aligning every moment with the arc of a vision. They understand something most people never learn. Wealth is not built by speed. It is built by duration. Duration of consistency. Duration of belief. Duration of calm. People who fear time try to outrun it. People who understand time learn to move with it. That is the difference between the person who endlessly hustles and the person who endlessly compounds. One is accelerating exhaustion. The other is accelerating inevitability. The wealthy don't need the world to move faster. They need only to remain in position long enough for the world to catch up. And when it does, the result looks miraculous. It looks like overnight success. It looks like luck. But what it really is uninterrupted alignment with time. The poor fight time. The wealthy collaborate with it, and collaboration always wins. Patience is not something you learn in the market. It is something you learn in your life outside the market. If your life is chaotic, your investing will be chaotic. If your relationships are unstable, your decisions will be unstable. If your identity is fragile, your confidence will be fragile. The wealthy understand that patience is not just a mindset. It is a lifestyle ecosystem. They intentionally design their lives to reduce urgency. They structure their finances so they are never forced into desperate decisions. They build emergency funds not because they expect disaster, but because they want to eliminate emotional vulnerability. They avoid lifestyle inflation because they do not want to become dependent on high income to support their identity. They keep their needs small so their freedom remains large. They build a life with space, mental, emotional, financial space, because patience requires room to breathe. They also build meaning outside of investing. They have creative hobbies, intellectual pursuits, strong friendships, physical health practices, family presence, quiet rituals. Their fulfillment does not depend on their portfolio to entertain them or validate them. That is why they can sit in stillness. Their lives are already rich before the money compounds. Most people cannot wait because the market is the only source of excitement or identity they have. The wealthy are patient because their purpose is wider than profit, and that is the deepest key. Patience is easiest for the fulfilled. If your life is empty, you will demand your portfolio fill the emptiness, and portfolios were never designed to carry that weight. The wealthy do not ask their investments to make them feel alive. They ask their investments to make them free. Freedom requires patience. Patience requires stability. Stability requires design, so they build a life that supports the kind of mind wealth requires. Emotional minimalism is the practice of removing unnecessary emotional movement. It is not numbness, it is clarity. It is the ability to feel without being hijacked by what you feel. Most people have emotional reactions layered on top of emotional reactions. They feel something, then judge the feeling, then fear the judgment, then panic about the fear. The wealthy strip all of that away. They let emotion arise, they observe it, and they let it pass. No attachment, no identity, no story. Just sensation, acknowledged and released. This emotional minimalism is why they don't crumble in volatility. Their emotions don't explode. They move through. They do not get caught in spirals. They do not catastrophize. They do not chase validation. Their emotional world is sparse, intentional, organized, and because of that, their decisions are clean. The poor investor believes they need more emotional intensity to stay engaged. The wealthy investor knows too much emotion is the enemy. They practice calm as a technique. They breathe deeply when volatility rises. They slow their voice and posture when fear spikes. They withdraw from screens when excitement appears. They engineer emotional neutrality because neutrality is the only state where intelligence can function. Wealth is emotional architecture. The richest portfolios are built in the quiet mind, not the frantic one. Stillness is often misunderstood as inaction, but in reality, stillness is strategic posture. It is the readiness to move when needed, and the discipline to not move until needed. It is the ability to hold tension without resolving it prematurely. Stillness is the highest form of control because it demonstrates mastery of self. The wealthy treat the market like a river. They do not jump in at every ripple. They watch the current. They wait for alignment. They enter only when the flow is in their favor, and then they let the river carry them. Stillness is not laziness. It is leverage. Noise tries to rush you. Fear tries to corner you. Greed tries to speed you. Stillness refuses all three. Stillness is not the absence of thought. It is the refinement of thought. It is the state where clarity accumulates while others are clouded by urgency. In a world where everyone is reacting, the one who can still see clearly becomes unstoppable. The entire point of investing is to let the market work so you don't have to. Yet most investors never allow this to happen because they won't stop interfering. They treat investing like gambling instead of engineering. They think profit comes from action instead of structure. The wealthy build the structure and then step back. They allocate, they diversify, they set rules, they automate contributions, they protect their downside. And then they let time, mathematics, and compounding do the heavy lifting. The market is a wealth machine, but only for those who don't micromanage it. In the end, becoming wealthy is not about predicting the market, outsmarting others, or moving faster. It is about learning to remain calm while the world shakes. Wealth belongs to those who can stay still in storms. Wealth belongs to those who can wait when others rush. Wealth belongs to those who can trust time more than impulse. The market is not chaos. The chaos is inside us. Master yourself, and the market becomes simple. Patience is not waiting. Patience is choosing not to abandon your future. And that is why doing nothing is not just a strategy. It is the strategy.